Welcome in, everyone, to another episode of the Real Estate Tax Playbook, where we discuss all things real estate, providing timely and precise tax information to real estate professionals looking to grow their business and build their own customized tax planning playbook. As always, I'm your host, Evan Ross, tax director with Brown Evers & Company, based out of our Roanoke, Virginia office location. If you haven't had a chance to check out Brown Edwards yet, please visit our website. A link to that website can be found in the description of this podcast. On the website, you'll find more information on our service lines, as well as our service providers and our other office locations throughout Virginia, West Virginia, and Tennessee. With all that, I'd like to go ahead and welcome in our guest for today. This is actually a first for me. We've got two guests with us. We've got Dave McGuire and Justin Gephart with McGuire Sponsel. Welcome, guys.
Hey, thanks for having us.
Of course. Well, I kind of like to start every episode with kind of a lighthearted conversation. So earlier this week, we had a call. One of your colleagues, Mike, he was on the call, had a nice bourbon barrel in the background. So didn't get a chance to really talk about it earlier this week. But are the two of you all into bourbon? Is that something you're take part in?
Hopefully you're not asking us to pull it out, because we're recording this in the morning. So if we start pulling out our drinks, it might say that we've got a problem. But yeah, I think we've all got a few too many bottles. Is really so we enjoy it. My wife might say it's a problem with the amount we spend on it, but hopefully it's not yet.
Yep, very good. Justin, you as well?
Yeah, we turned into a fun little thing within our firm. You can see in the background of my office, we've got a barrel head here, and
yep.
Part of our client gift sends on an annual basis. We take a trip down to distilleries and do the private selection to come up with something unique. But it's certainly a fun time that we enjoy. It gives us an excuse to have a little bit of a boys trip.
That's awesome, man. You can't go wrong with that. So I'm part of a similar bourbon club, not through work. Maybe I need to talk to Brown Edwards about getting that started. But we've got a group that does tastings, barrel picks, and stuff like that. So it's a cool experience and kind of a good opportunity to bring some folks together. So,
well, unfortunately, Evan, we just don't.
I go to anything 12-year. Wild Turkey 12 years, probably my favorite. Have you all ever had that one?
Mm-hmm.
Yeah.
Mm-hmm. Yeah.
I like that one a lot. Knob Creek 12-year, really good. Weller 12-year. Anything aged 12 years, I'm a big fan of. What about you all?
Yes.
Bourbon.
Yeah, I mean, if you're gonna give me some Weller 12, I'm not gonna turn it down. I personally, and I know the bourbon purists wouldn't like it. I like a lot of the finished bourbons.
Okay.
So I like a lot of the obviously the mass produced one is Angel's Envy. Everybody knows about Angel's Envy.
Yep. But
we did some stuff down at Bardstown Bourbon Company years ago. They've got a lot of good aged ones. It seems like a lot of the companies that are doing a lot, you're talking about the 12-year, a lot of the aged ones tend to be a little younger, and they're adding a little bit of the aging to add some flavor profiles onto it. So I think it just brings a little bit of a interesting twist to a lot of them.
Oh, yeah.
And our private style, I will tell you, I think it was our 2015 private selection that we did, is probably one of my most favorite bourbons.
Really?
I wish we had more of those bottles, but
that's the only bad thing about those. There's only a finite number of bottles that they get produced when you do those.
And we've tried to reinvent it every year, and we haven't been able to get close to it. So whatever we did in 2015, we just happened to stumble into greatness.
That's awesome. I wish I would have been there in 2015 to give it a try, but that's awesome. So, and I'm actually we'll get going in just a second. I'm actually going to London next week, and found out that they actually opened a Buffalo Trace in London last year. So definitely going to go check that out. We'll see how it compares to the Kentucky location, but we'll see. I'll definitely try it out. It's on my list.
Awesome.
So very good. Well, I'm sure everyone would like us to move on and not talk about bourbon, or there may be some listeners out there that want to just talk about bourbon. So if so, reach out. But with that, David, Justin, you want to give a just quick introduction about yourself, what you all do at McGuire Sponsel?
Yeah. So McGuire Sponsel is a specialty tax firm. We've been, well, I say specialty tax, but we do things outside of tax now, but we've been around for since 2007, I should say. And we work primarily with CPA firms, helping in these areas of specialty tax, whether that be on the real estate side, cost segregation, property tax consulting, 179D, and some of these other buzzwords that people have heard of. We go beyond that into R&D tax credits and international tax credit consulting. So we're this weird mix. I always point out for myself that I've been doing this work for over a quarter century now. Not to age myself, but let's put it this way: we've got a lot of staff people that weren't alive when I started doing this work at this point. But I am one of those weird people. I have an engineering degree, not an accounting degree. So I work in accounting, but I've never taken an accounting or business class in my life. So maybe take some of what I say with a grain of salt. But I have been doing this a long time.
Very good. Justin, how about you?
Yeah, shareholder McGuire Sponsel, started off in public accounting for about 6 years. So I've kind of sat on the other side of the table from a lot of our alliance partners, obviously. So I think bringing that perspective to a lot of the conversations is beneficial. But joined McGuire Sponsel back in 2012, started out within our cost seg practice. That's grown into a really large part of our firm. Since then, I have helped kind of develop our BD function, which has then transitioned off to our director of that, Tim Lemasters. I have now jumped over to our location advisory and also helping to start our property tax division. So kind of worn a lot of hats over the last, 13, 14 years, but ultimately it comes down to bringing value to clients and delivering a lot of successful results to them. That's what I enjoy.
Very good. Well, we appreciate the relationship we have with McGuire Sponsel, and our team's been able to interact with you all on some engagement. So I appreciate that, and you all obviously have your feet in a lot of different areas. So you mentioned one, which we're going to talk about today, property tax, kind of starting that practice and taking that off. So if y'all are okay with it, why don't we start with that for the conversation? Property tax assessment. I mean, obviously, prices have been rising with everything. Even me I got my property tax bill last year. 75% increase. I was like, what is this? So when would you consider evaluating your property assessment? When's a good timing for that?
Yeah, great question. I think a good starting threshold, if you're paying $50,000 or more in property tax, it's at least worth the conversation. If you look over the last 4 to 5 years, you had COVID, you had the Great Resignation, remote workforce, you have market cap rates that are fluctuating. Those are all really good kind of opportunities or indicators that we potentially should argue against the assessed value. So if that threshold $50,000 and up, let's at least have a conversation. From an industry perspective, we can take a look at a lot of, I would say, rental income industry. So think about commercial office space, retail, if you have a shopping center, those have been hit over the last few years. Multifamily, depending on kind of where you're at in the lease up space, those are all prime opportunities right now to take a look at.
Very good. And is that $50,000? Is that typically on one property, or is that within a portfolio? How do y'all look at that if it is a large portfolio?
Yeah, we typically say per property.
Okay.
And the reason behind that, so let's say you pay $30,000 in tax liability. If we come in and get a 10% reduction, we're saving you $3,000. Well, within that process, obviously we have the fees associated with that study, but then some counties and local jurisdictions require an appraisal to be performed.
Okay.
And so when you start adding on extra costs, filing fees like that, it starts to minimize the benefit, and sometimes you may not even have a benefit by the time you get done paying for an appraisal. So that's where that $50,000 really does, whether it's individual or portfolio, really starts to kind of set that threshold.
Very good. Thanks for clarifying that, because obviously that's a little different than cost seg. Sometimes cost seg, you can look at a portfolio of properties, whereas looks at property tax assessment, you're really looking at a property by property assessment.
Yeah, and honestly, our cost seg practice really started our momentum in this, because as part of that process, we're pulling property cards to help calculate land values. And we just started, as you mentioned earlier, your value shot up 75%. Well, over the last 5 to 7 years, we keep seeing those values just jump. I mean, sometimes 200-300% jumps at a time. And a lot of the local assessors are doing mass calculations. It's not taking into account what the local environment is, what the economic conditions are. So that's really what drove our decision to get into property taxes, talking with a lot of our clients and seeing what are their pain points. They kept bringing up, man, we are paying so much in property tax. It keeps going up, and we don't have a method to help out with that. So that's why we ended up bringing that in-house.
Very good. Very good. Yeah. So I guess that a little bit of a segue into just the cost of everything going up. We'll talk about tariffs a little bit today, but the cost of everything going up. So this assessment could help combat that. Dave, I'll let you kind of chime in on that piece.
Well, when we see the cost of everything going up, that's going to increase the cost of new construction. We see the cost of real estate going up. We've seen that over the last few years. And anybody who's tried to buy a house knows it, but it's also on the commercial side we see it, where the cost to buy a warehouse goes up. Keep in mind, when we're talking about property tax in particular, we're specifically talking about there's multiple different appraisal methodologies. So we can be looking at, as Justin mentioned, we can look at where they are in the lease up on an apartment complex. Well, that's going to affect their income approach. So when we start going through either the income approach, sale comparable, or cost to produce, we can look at any of those different approaches and potentially adjust it on a property tax. But to your point, the cost of goods are going up, and that's going to start affecting real estate people no matter where they are in the environment, whether they're the buyer, whether they're the seller, whether the developer, no matter where you are in that continuum. If you see the cost of lumber go up, it's going to affect you somewhere. If you see interest rates drop, well, that could lead to more people in the marketplace, that's going to increase the cost of sales. So all of these things kind of have this interplay, and it's important to know where we stand. And now the cost could affect your profit margin. So you mentioned earlier, you said, well, cost seg, we could do portfolio. So you mentioned the cost seg side of things. So let's say I'm a developer and my costs start going up. Well, cost seg might not be an opportunity because I might not have the taxable income. But yet then I get my assessment notices from the state and local government. All of a sudden I'm getting assessed for all this tax, even though I don't have tax liability. That's where property tax can come into play, because we can adjust those fixed costs to help offset these rising costs in other areas.
Very good. Well, that probably also helps out me asking the question. You can't just call your assessor, your locality, and saying, hey, I think this is too high. Can you all adjust it? Dave, you kind of, maybe you can. I don't know if that's going to be successful.
You can do anything you want. Whether it's going to work is a difference.
Yeah, exactly. So you kind of mentioned methods. I think, Dave, you were kind of talking about income approach and two other methods. Can you all speak on how those methods work and what that process looks like with a property tax appeal?
Yeah, on the income side, I would say that's probably the most primary argument for a lot of companies. And so again, we're wanting to take a review over the last 2 to 3 years of their P&Ls, of their income statements, to see what the revenue looks like. The industries, I mean, think about from, as I mentioned, a couple of those things that have happened in the market the last 4 to 5 years. Okay, foot traffic's down in a lot of retail centers. I was just at an event about 3 weeks ago where they said that foot traffic in retail centers is only at about 70% of what it was pre-COVID. So that means revenue is likely not where it should be. Vacancy rates, we've seen remote workforce. You see in the CPA industry, firms, instead of going out and expanding their footprint or expanding office space, are actually shrinking. The head count's not there. So the building that we're sitting in right now, it's highly vacant because a law firm left, a CPA firm left. They moved to a different part of town. They're actually converting it into the top 4 floors into hotel space.
Oh, wow.
That also goes into kind of the calculation. There's a change in business function right there. So we take a look at, from an income perspective, does the income match up with how the property is being assessed? Inside that income argument is that cap rate. Typically, when you see cap rates rise, market values drop. Well, market cap rates are rising, and they have been rising in the last 4 or 5 years. But as you indicated, your value has not dropped. They continue to go up. So it's a really good indicator. The other one, from a comp perspective, that typically deals with your owner-occupied clients. So You got a client that maybe is manufacturing, they own the real estate that they're operating in. So the rental argument, really, there is no argument there to be made. So then we start to look at from a comparable standpoint, what is the price per square foot of the fair market value of other like-minded properties in the area. Those are the two main ones. The cost approach, we're essentially taking a look at that and saying, okay, what does it cost to rebuild this facility, and how does that match up with how it's being valued? That approach is used probably the least out of the three. Like I said, I would say 90% really hang their hat on that income approach.
One thing that Justin kind of pointed out, which I'm just going to dive into a little bit more, is change is often can lead to some of these opportunities. So Justin was kind of pointing out this building we're in, where it's sitting empty, and they're going to be putting a hotel in it. Well, there's an opportunity, number one, to get the assessment lowered because they're not making any money on it.
Mm-hmm.
But then potentially when they start making those changes, looking at where that is on the federal side, there might be a tax depreciation play. A big one for that we're seeing quite a bit right now, especially in large urban centers, is changes from commercial to retail or commercial to residential. And when somebody's switching from commercial to residential, there's actually a play there on the depreciation side as well, because then you start playing with what's called QIP, or qualified improvement property, which even though they're moving to a residential, which is not eligible, if they time it right, they can get a large portion of their improvements listed as QIP and bonus it out. At the same time, because the property's being changed, it's got that income approach is dropped. So now we can show that there's probably a less value on the property tax side. So when we try to look at some of these things, it's important that people look at it holistically and don't just go, you know what, I need to hire a property tax person, or I need to talk to somebody about depreciation. You sit down and you go, okay, what are we planning on doing over the next 5 to 10 years on the real estate side, and seeing where they can play those out. Justin mentioned earlier, he works on the location advisory. Well, if you're sitting there as a business owner and you're making a change so you can increase your presence on the manufacturing side so you can hire more people, there might be a play there. So we see a lot of these things as interconnected, and it's important that people look at them that way.
I completely agree. I find so many clients or prospects or whoever they are, they come in, they're so dialed in on one specific item, either depreciation or property assessment, whatever it is. But we try to sit down and look at everything holistically. Like you said, look at the goal, long-term, where you're trying to go with this, and then figure out a game plan from there.
Mm-hmm.
So that's great. As far as success rate, what do y'all see in the property tax appeal? Do y'all have those numbers, or what are y'all seeing?
Yeah, I think our team does a really good job on the front side of trying to pre-qualify these facilities. So I think it's who do you partner with in that circumstance. We're not a group that's just going to go out and mass appeal everything. Mm-hmm. So we want to make sure that there's actually a legit argument behind the appeal. And I think when you get to that aspect, the win rates are much, much higher. Now, certainly within this, there is some risk. Assessor can just flat out reject it. Even with the strongest arguments, unfortunately, we see that from time to time. I would say it's probably less than 5%. But from time to time, the assessment boards just flat out reject it, no matter the argument. So you can take the strongest argument. We've had cases where we've had home run arguments, we thought, and the assessor rejects it. We've had others where we thought the argument was good, but maybe a little bit on the weaker side, and it gets approved unanimous, from a unanimous decision. So we do our best to qualify these on the front side. We have a lot of preemptive conversations. The cool part about the assessment process and the appeal, a lot of these counties or local jurisdictions, they open up for an informal process, which means we can call them up. We just have discussions, just like we are right now. We kind of talk to them about our client, kind of what they're going through, and we start to get a really good feel for it. Our goal is to have a lot of the appeals settled in this informal time frame. Now, if we still feel like we've got a strong argument after talking to that assessor and we're still not seeing eye to eye, that's when we enter into that formal process. But I think our team has done a really good job of pre-qualifying these on the front end to help with those success rates.
That's great. That informal process you mentioned, is that kind of a standard throughout the majority of localities you all interact with?
Yeah, I would say for the most part. There are certainly areas within our country that are a little bit more difficult to work with, and they keep it very rigid through the formal process. But I would say most of the time it's a benefit to them to have an informal discussion, because likelihood there's going to be some negotiation. We're probably both going to give up a little, so that way everyone's happy in that aspect. If we get to the part where it's a more formal process, well, that's when we're bringing in the formal appraisal. We're bringing in a lot more evidence. We're bringing in a lot more documentation that supports our value. So it ends up being probably less favorable for the local community and more favorable for the taxpayer if you get to that aspect.
Okay.
But there is more cost associated with that for the client, because they have to pay for the appraisal. The filing fees tend to go up when you get to that from that aspect as well. So we try, like I said, we try to get as close to where we want through the informal process. But we're certainly, again, if we're launching an appeal, it's because we've done our due diligence on the front side and we're comfortable going through that formal process.
Okay, that's great. Yeah, I wanted to ask because obviously, as you all know, every state locality has a different approach or opinion on different items. So I wanted to just see if that was kind of a standard that you all are seeing. There is that informal process available to taxpayers. Are you seeing that there's a percentage reduction you're typically seeing? I'm assuming when you do that formal process, there's a report that you produce. Is that correct?
That's right. Yeah, I would say on the average, and this is a wide range, but depending on the industry, you're seeing anywhere from 10 to 40% average reduction in those values. We just got done performing a study on a hotel in North Carolina. We ended up getting that about a 55% reduction. It was assessed a little over 90 million, and we got that thing down to about a $40 million assessment. So again, depending on the industry, depending on kind of where their circumstances are, their scenarios, that specific hotel, their business was down. It was a tourism hotel. Over the last couple of years, it's taken a hit. And so we were able to negotiate a much, much lower value.
That's great. I'm sure that client was very happy with that result.
They were thrilled. They were happy to pay our fees.
Yeah, I'm sure they were. Well, that's great. So we talk about all this, all the appeals. There's been conversations about potentially states eliminating property taxes. Do you all see that happening at any point in time in the near future?
Short answer, no, but long answer, maybe. So if we look at states that have tried it, I think it was one of the Dakotas, it was either North or South Dakota, had it actually as a ballot initiative on this last election. It was the second time they had it. Now, they did see an increase in the people voting for it this time around, but it still failed relatively easily. And the problem is you have to figure out how to pay for services. So I know Florida's been pushing it. Well, if Florida pushes it, they would have to increase the state sales tax in order to handle that. And now you're looking at potentially and the issue is obviously some people are, hey, consumption tax is great because it forces everybody to pay a little bit. The problem is that it ends up being a little bit more regressive. And so you think about it on the home ownership side. So you mentioned your own home. We all have homes. I don't want the tax to be high on my home, but I also don't want to have to go out and pay more at the grocery store. And that's where it comes into play, is how do you make up the difference? How do you fund the schools, the roads, et cetera? The other issue with property tax is it tends to be more stable for the government. So that's where governments would really struggle. If they go to a consumption tax and we go into a recessionary period. Well, if they sit there and they go, okay, we'll simplify it. I've got 100 homes in my town. Each home's valued at $300,000. That gives me $30 million worth of assessment. I assess at X dollars per rate. I know exactly how much money's coming in next year. You change that to a consumption tax and you go, okay, I'm going to tax everybody. I think the Florida said about 17% consumption tax. You switch to a consumption tax and you hit a recessionary period where people are pulling back on their purchases at the same time that you're seeing that recessionary period hit and you need more community efforts. That's when you start seeing that pullback. So I think states are going to struggle with it a little bit. And that's why the Dakotas actually failed in this last go around, is a lot of the state associations and the state government, whether it be the firefighters or the teachers unions and everything else, lobbied heavily against it. And that's what really came down to. So we'll see. What it does show me is that this is a pain point for a lot of people. So when we see people talking about it, if we see people talking about taxation in general, we know it's hurting people. So people don't like paying that assessment bill.
Mm-hmm.
So it goes back to, okay, if we're seeing this being a pain point, what do we do about it? So yeah, we can argue whether you agree, hey, this consumption tax good, property tax good. Take that off the table. We know right now people are overassessed on property tax.
Yep.
So we can argue it might happen or it might not, but what we know is it's a pain point for people. Otherwise, it wouldn't be in the conversation.
I get the frustration absolutely on that line. I mean, think about it. You pay off your home. Guess what you still have? Guess what you still owe? You still owe the property tax. So I certainly appreciate the frustration along that lines. I think it's it's one of those things that sounds good in theory of eliminating the property tax, but as Dave mentioned, it's such a stable source of revenue for these states. How are you going to replace it? It's just going to be taxed elsewhere. So I think it's something that it's a conversation starter. I think it's popular in today's society from a discussion point, but when you actually get to how practical it is, that's the challenge. I mean, several states are going through these discussions right now. So I think it's something to at least talk about.
It'll be interesting to see because in some ways we're testing the appetite for consumption taxes right now. Whether we claim it that way or not, that's what some of the tariff conversation is. It's the beginning of a consumption tax. Does that change the national attitude towards, hey, these consumption taxes work great, or does it push away and actually slow down some of that movement towards consumption taxes in lieu of assessments on property and other things? I don't know. I do know that a lot of states in the past have pushed back. I could see personal property taxes on states, was it about 15 years ago, Ohio moved away from a personal property tax and went solely to real property, especially for businesses, because the personal property tax was becoming a little bit of too much of a burden for businesses. Now, will we see that? I can see that happening before moving away from the real property taxation in states a little bit quicker.
Yeah.
Well, Dave, if the consumption tax can slow down the Amazon deliveries to our house, I'm all for it.
Yeah, but they pulled that off. They're not going to tell you what that is. It does show up on your Temu order, Justin, but it does not show up on your Amazon order.
Listen, my wife has not found out about Temu yet, so let's not tell her.
Yeah, make sure she does not listen to the podcast. Make sure, don't tell her you were recording today. So very good. Yeah, we have the same issue with Amazon frequently coming to our house. But anyway, I appreciate that comparison and that discussion because obviously with any state, they're gonna have a balanced budget. If you take something away on one end, you're gonna have to find that income somewhere else, whether it's consumption tax, the real property tax, personal property tax, what have you. We could probably have a conversation for an entire episode on consumption tax, and so we'll go ahead and move on. But I do appreciate that comparison and kind of explaining what that looks like and what that means. So hold on for the future. We'll see what happens. So, well, let's talk a little bit. I mean, we started talking about state legislation, things of that nature. Let's talk about upcoming federal tax bills, legislation. Mm-hmm. Dave, Justin, what are you seeing on the horizon? Obviously, bonus depreciation is a big one. We can talk about that, but what else are you all seeing?
Yeah. So we do see that obviously, and as we're recording this, they have not actually officially released a tax bill. They did release the budget blueprint. We saw the one that initially the House released one, then the Senate released one, then the House eventually adopted the Senate's version. Now, that does not put any tax legislation. All that does is say, here's how much money we can spend on tax legislation if we move forward. Now, when we're looking at that, we do see bonus depreciation being a big one as it relates to real estate holders. Where does that stand? Well, typically when we see a new tax bill, it's retroactive only up to the day that the tax bill is released. So when we look at the TCJA, if you remember back in 2017, we had a specific date when the TCJA was released, and that's when bonus depreciation started. The assumption right now is they're going to try to get this 100% bonus depreciation back to January 20th because the president asked for that in his speech to the joint session on Congress. So he pushed for that back then. We expect to see, there's other areas though that we need to deal with. 163J. I'm sure a lot of the people listening have had to deal with 163J, which is the interest limitation. I don't see that going away, but most likely we'll probably see a push back to EBITDA where it switched to EBIT over the last couple of years, which sounds like a minor thing, and but when we start adding depreciation and amortization in, so it's earnings before depreciation and amortization, that's great, especially if you have high depreciation numbers. So for those real estate holders that are saying, look, I have $5 million worth of depreciation. Well, when your 163J is limited to EBIT, all of a sudden you're taking $5 million out of that calculation. It's a big number for people. So I would expect to see 163J go back there. Obviously, we've got qualified business deductions. You've got a lot of different things that go into play that could be in the bill. We just don't know what it looks like. We don't know. There was a lot of talk about, as it relates to developers, there was a lot of talk about taking away potential tax on overtime, the no tax on overtime. That could affect a lot of developers with their hiring decisions. There's also questions as to whether or not if they do that, do they change the definition of overtime so you're not forced to pay out overtime at the same. So until we see the meat and potatoes behind it, it's very difficult to plan for. But the expectation is we will see something. We're hearing anything from late May to the fall, sometime this summer, probably right around the time we all decide to take vacation. They're going to send out a bill and ruin all of our vacations because we're going to be sitting there reading it instead of enjoying time with our family.
That's the way the government always works. They like to throw stuff in last minute or at the worst time possible. So
I always tell people, if you're waiting for a revenue procedure or details behind something, I can guarantee you it's going to come out on the Wednesday before Thanksgiving or another time when there's a holiday weekend, so they can all go home. As we come up with questions, they don't have to answer them for 4 or 5 days, and it's like clockwork. You can look it up, and almost every year, right before Christmas or right before Thanksgiving, regulations always drop the day before.
Yep. There's been a history of that. So yeah, everything you mentioned are the hot topics that I'm expecting there to be something to happen with. We'll see what that is, whether it is 100% bonus depreciation, the 163J. I have a number of clients that they're asking like, what? I should have this huge loss this year. I'm like, well, you've got the 163A limitation. I have to explain that to them. So it would be nice in that depreciation amortization point if that goes away.
And that
the
comes
crazy
into
part about bonus, though. I mean, with 100%, I think back in the day, Dave, you and I were doing cost seg before 100% bonus was a dominant feature.
Justin, I've been doing cost seg since before bonus was a feature. So keep in mind,
but that was supposed to be utilized for economic downturns, and they've left that spigot, so to speak, turned on for so long that it's just become part of business decisions. For the past 2 years, talking to a lot of real estate developers, they're all holding up on making potential investments based around this potential bump back up to 100% bonus. So unfortunately, they've left this thing on so long that businesses now are relying on their decisions around that, which I don't think is a great thing. I mean, we used to be able to talk about, hey, this is going to increase your cash flow over 5 years. We can't come to clients with that conversation right now because they're going to say, well, what's my benefit this year? And that's the bonus impact.
Exactly.
I will also say the problem that we see, Evan, with the 163J is it affects your bonus decisions. Mm-hmm. We mentioned earlier this building that we're sitting in. Well, this building is an office building. Most likely the people holding it have high interest. So they might be sitting there going, do I elect the real property, trade, or business? But now they just bought this. So do they elect that in the first year? Well, they're considering building a hotel over 4 floors. That's going to be a huge amount of qualified improvement property, which is right now, today, it would make sense to do the real estate trade or business election, which then gets them into a situation, though, where they can't take bonus on all the QIP they put in. So if they bring back 100% bonus that hits while they're doing this renovation, making that election on this return after they bought the building could be a bad decision.
Yep.
But they don't have the information. So we recently, as a firm, Justin and I know this, we sat down and we've been doing a lot of planning as to where the firm wants to be in 5 years. And any of your clients who are real estate developers, you know this, you sit down, you do a lot of planning for what do we do over the next 6 months to get us where we want to be in 5 years.
Yeah.
The last few months have been very hard to do that with because we've had these questions as we mentioned tariffs. Are tariffs going to be on in 6 months? Or are they going to be off in 6 months? Are they going to be 10% or are they going to be 150%? So do I move my manufacturing location? Do I start as a developer? Do I start developing manufacturing buildings as spec buildings, expecting people to pull manufacturing back into the US? Or do I build warehouses because maybe these, for example, they pull the tariffs off Temu, but they change it so now you got to pull in and warehouse more stuff in the US. Mm. It's very hard to make these planning decisions. Bonus depreciation. Is it on? Is it off? Where's 163J? Do I have to make the real property trader? But all these decisions need some type of certainty. Now, what we can do, and this is where kind of the property tax and other things come into play, is we can look at where we are today, maximize the cash flow by minimizing expenses, be property tax or something else, to then help us weather those ebbs and flows until we see some type of stability come back in where we can then start planning that 5-year future market.
Yeah, it's a good point. Good point to make. And it kind of takes us back to the property tax assessment, how that's a fixed cost and something we can make a decision on right now, whereas the bonus depreciation, other items, kind of up in the air. But I'm having the same conversation with my clients, trying to make those short-term decisions for long-term goals. It's a challenge right now.
Yeah, it's a challenge for every. I mean, you think about it in your personal life. I always separate it down to my personal life. If I'm sitting there going, hey, I want things to be better 5 years from now, then I start sitting there going, okay, do I cut out my cable TV? Do I cut out? Do I need Hulu, Netflix, Amazon Prime, HBO Max, all these different streaming, or can I cut down to one streaming service for a while? And it's the same thing on a business side. As you sit there and you go, look, I want to plan for the future. Okay, do I look at property tax? Do I look at, hey, maybe I've filed my 2024 return or I put it on extension? Do I look at doing some cost seg studies to minimize my tax liability, to get cash in my pocket so that as these things are ready to go, I've got the cash and I've got the war chest built up and I've minimized my expenses so I'm ready to be the first one to market on some of these changes and accessing some of these opportunities that are going to present themselves over the next couple of years.
Great. So you're willing to cut the cable bill, but not the bourbon consumption?
Well, I don't have to tell everybody else about that. Hopefully none of my kids or my wife are watching this podcast and they're going to go, when I say, hey, we're cutting the cable bill, they don't think that far in advance.
I don't know your family, but I assume they're probably not listening to the real estate. But if they want to tune in, I'll take any subscribers I can get. So very good. Well, I appreciate both your all's time today. I think it was a good conversation. All the listeners out there, if you want to reach out about property tax assessments, the tariffs, the current economic footprint of what it looks like in real estate, please reach out to myself, Dave, or Justin. We'd love to continue those conversations. Dave, Justin, give you the opportunity. Just anything else you want to add to the conversation today, I'd love to let you do that, as well as provide your contact information.
I don't know, nothing else to add. Thank you for hosting us. I think it's been a good discussion today. You can reach me at jgephart@McGuireSponsel.com. Also, from a phone number standpoint, 317-564-5006. You also can find us at our website, McGuireSponsel.com.
Yeah. As Justin just said, you can go on our website. Both our email addresses are on there. I believe our direct phone numbers are on there. Yeah. If anybody listening wants to try calling me as I'm driving home from work, my cell phone number is 317-460-9814. I always tell people it's one thing to listen to somebody talk on a podcast or a presentation for a half hour. It's another thing to call us randomly at 5 o'clock on a Thursday night and see if you can trip us up with a difficult question. My theory is test me to see if I actually know what I'm talking about. So if you got a question about anything I've said today or anything I haven't said, feel free to call me, get me on my cell phone, and throw a random question at me.
Yeah, let's just be clear. If you want to call and talk about tariffs, Dave's your guy.
Yeah, do not call Justin.
No, property tax, bourbon, sports. Call me anytime.
Tariffs, Dave. So,
and if you want to send a bottle of bourbon, our address is on the website too.
Okay. We'll see what we can do. So maybe I can get a hold of us up next private selection y'all do. So very good. Well, that is a wrap for this episode. Again, I appreciate you two jumping on, being great partners of Brown Edwards and being a part of this podcast. All those listeners out there, please make sure, if you haven't already, subscribe, like, comment. Would love to have you continue coming back, give us feedback. We'll be back next time with another episode. Take care.